In this recording, we're going to focus on advanced sales variances, which is Summer 18, question 1. So again, advanced variances, either sales or costs, usually come up once a year, either the summer or the autumn paper. In 2018, it was the question 1 in the summer paper for 11 marks. They want you to calculate the 2017 variances for X, Y, and Z heating systems, and they're asking for 5 different variances: sales price, sales volume, sales mix, market size, market share. Now, what we're going to add in there as well is we're going to do sales quantity, because you should know from your cheat sheets that you've already done, these two are cap 1 variances, sales price, sales volume. But this particular variance, the sales volume variance, that can be split into sales mix and sales quantity, or it can be split into market size, market share. So the examiner usually gives you the two cap 1 variances to allow you, give you a kind of rule of thumb or a guide as to whether you've got the advanced variances right or not. And we don't really ask you too much narrative questions here. We'll talk to you about how you interpret those variances, because often that's where students let themselves down. So here it's variable costing system, so that means we're focused on contribution. 11 marks out of a total of 58, so you've roughly about 20-22 minutes to do a question like this in the exam. So we come back up. I'm assuming you've read through the question. If not, try and pause it now and read through it. But generally what you'll see in the case study is the examiner will give you a background paragraph, but they'll also give you subheadings then for each part. So the first subheading, strategic alternatives, that's related to all the financing requirements, part A to D. And then sales evaluation, that's related to the management accounting requirements for the rest of the question. So the background of this is O'Neill Thermal Engineering. The main shareholder, Mike O'Neill, died in 2015, and he left it to his 3 children, James, Tim, and Jane, at a third holding each. So neither of the 2 lads are interested in running the business, but Jane is a qualified engineer. She's thinking about taking over the business. And there's an element of company valuations and financing, which is part of the overall case study that we're not looking at this particular recording. What we are looking at is their particular evaluation of the heating systems they provide. X, which is aimed at the domestic market, Y at the commercial market, and Z at the industrial. They don't sell to the public, they're sold through a network of retailers. So again, all this information is given to you for a particular reason, because they're looking at, can you interpret it and what does it mean in terms of variances. So we've recently spoken to our brothers in Alf, the CEO. They suggested launching the X heating system in the Canada and US markets. So we're getting into the international markets, and they're looking at a particular pricing strategy. So again, that's related more to the following parts F and G, which you can have a look in your own time around performance measurement. We just want to focus this particular recording on the variances and their interpretation. So you go to your appendix then, which is usually at the back of the question, and you're given appendix 2, the budget, don't mix them up, for X, Y, and Z, and the actual. So you'd be amazed the amount of students under exam pressure who mix up budget and actual, and of course get all their variances in reverse. And then you're given the markets for domestic, which is X, commercial, which is Y, and industrial, which is Z, which you'll need for the market size and market share variances. So what we're going to start with is then sales price and sales volume variances. And we're just going to lay them out like this. Sales price, nice and neat, and we're going to do X firstly. So sales price is looking at, do we sell it for more or less than expected? I usually don't worry about positive or negative figures. I leave them all positive, and I then label them adverse or favourable, so to avoid confusion. Budget, you expect to sell X at 850, you only sold it at 800. So you're 50 adverse, and it's going to be multiplied by the actual volume. So here, 850 versus 800, and you always multiply by the actual quantity, which is 8,000. So in this case, this is going to be an adverse 50 times 8,000, adverse. And we'll just tidy it up so it's in clear thousands. So 400,000 adverse is your sales price variance for product X, product Y, and product Z. Now remember, this should be bread and butter. You're not getting too many marks for this because it is open book. You should have the formulas with you. Expected to sell Y for 950, you only sold it for 875. So 875 versus 950. So it's going to be adverse, and your actual volume is 5,000 units. So you sold each unit of Y for 75 lower than expected, and you sold 5,000 of them. So that's 375 adverse. So in both cases, you sold them for less than expected. And the last one, product Z for the industrial market, you expected to sell it at 1380, you actually sold it at 1500. So 1500 versus 1380, and the volume you sold was 5.5. So this would be favorable. You sold each of them at €120 more than budget, and you sold 5.5 of them, which is 660 favorable, and you tot them up then, you're going to be left with an adverse variance net of 115, and that is the sales price variance. Now that is cap 1, shouldn't cause you too much hassle, but lay it out neatly. Make sure the examiner can see where they're coming from, and when you have 3 separate products, you do them individually and you add them up. So overall here, you've sold X and Y at lower than expected, you've sold Z at higher than expected. And we just do the same format then for sales volume. Your sales volume, what you're comparing here is budgeted volume, 10,000, to actual volume, 8,000. So again, this is going to be adverse. It's 8,000 versus 10,000. And this is where students get caught. In a sales volume variance, which you should have written down in your cheat sheets, you don't multiply by price. You multiply by either contribution per unit, the standard contribution per unit, or the standard profit per unit. In our case here, we are told we have a variable costing system. That means you should be focused on contribution per unit. And the standard contribution per unit, which means the budget, is going to be the 850 minus 150 minus 400 minus 145. So it's your sales less all your variable costs. If there was a fixed cost in there, you would ignore it because you're told in the question it's a variable costing system. So that is the standard contribution per unit there, 155. So you've sold 2,000 units less than expected, and you lose 155 then for every unit you didn't sell, which is 310 adverse. So that's unusual now, and that's a comment that you'll be expected to make in Cap 2 is, not only did you drop the price, but you dropped the volume as well. So clearly there's something gone wrong here, because usually you expect lower price would have higher volume, and vice versa in terms of supply and demand. Same with Y. Expected to sell 6, only sold 5. So it's going to be an adverse variance again. And your standard contribution per unit here, 950 minus 500 minus 190 minus 170. So your expected contribution per unit is 90. We're always using standard contribution per unit. The actual is not relevant here. That's relevant for the sales price variance and for all the cost variances, but it never comes into the sales volume. So that is going to be 1,000 units less than expected times 90, 90,000 adverse. Again, you've got that worrying relationship where the price was dropped, but the volume dropped as well. So it looks like there you've declining markets for X, the domestic, and Y, the commercial. They're the kind of comments and insights you're trying to have in your head in case you're asked for them, particularly in the subsequent parts. Finally, then for Z, you expected to sell 4,000, you actually sold 5.5. So this is going to be a positive variance, and your expected contribution per unit, 1380 minus 700 minus 200 minus 220 is 260. So this is quite a positive story. The industrial market seems to be going well. You sold 1,500 units more than expected, and each unit was expecting to get you €260. So that is favorable. So what you actually have here when you net them off, 10,000 adverse sales volume variance. So what's happening is you have two very poor sectors, the domestic and the commercial. They're lowering the price, but you're even losing volume. But the industrial seems to be doing very well. You're charging more than expected, and you're getting more volume than expected. So that seems to be the real growth target when we look at basic Cap 1 variances. So that's what we've done now. We've looked at our Cap 1 sales price variance and our Cap 1 sales volume variance. What we now know in our advanced sales variances is this 10,000 adverse, which I'm going to highlight in yellow. That can now be split into sales mix and sales quantity. Now they don't ask you for the sales quantity here, but we're going to do it for tutorial purposes, just to help you along, and we'll show you how to calculate it. You should have a cheat sheet done for these. We've talked about that in other recordings and the lectures, how you do it. And I'm a big fan for both the sales mix and the sales quantity. Do a tabular format. Lay it out in a table and have that table going into the exam. So for your sales mix table, it looks like X, Y, and Z down the first column. Then you have AQAM, actual quantity, actual mix, AQSM, actual quantity, standard mix, and you look at the difference. That difference is in units. You then label that adverse or favorable. To monetize it, and this is very similar to what you do with the advanced cost as well, you're multiplying by standard CPU, never actual. And the reason it's CPU here is we have a variable costing system. If it was a marginal or an absorption costing system, it would be standard profit per unit. So what these mean is what's the actual quantity in the actual mix? They're the actuals. So the actuals here for X, 8,000, 5,000, 5.5. So that's done. Your first column is nice and straightforward, and have those ready. Have that template done and have the little annotations. What does the first column mean? How do I get the second column, etc. The second thing you're doing is you're getting AQ 18.5, but what you want to know now is what would the sales mix have looked like if we had held SM, SM being the standard sales mix. So SM here for X, Y, and Z is based on the budget. You expected to sell 10,000 of X, you expected to sell 6,000 of Y, and 4,000 of Z. So overall sales expected to be 20, which clearly we're below, so that'll be covered in the sales quantity variance in a second. But 50% was the mix. You expected to get 50% of X of the total. You expected 6 over 20 is 30% of Y, and 4 over 20 is 20% of Z. That's your SM. And you take that SM now and you apply it to the actual quantity. Hence the phrase actual quantity in the standard mix. So if you held the same mix, half of your units should have been X. And clearly they weren't. There was a 1,250 difference. 30% of your units sold should have been in the commercial Y, and clearly they're not. There's 550 less. And 20% of your units sold should have been industrial, whereas actually you've sold a lot more. You've sold 1,800 extra of industrial. So that seems to be the big winner in terms of changing sales mix. So what we do then is you have to label them because they're the difference in units. Remember, this is the sales variances, so lower is bad. Cost variances, higher is bad. In this case, these are adverse and this is favorable. Little rule of thumb you should have in your cheat sheet is the difference between these two columns should be the net difference here. I.e. there's no difference in the quantity, so essentially you're just swapping one for the other. It's 1,800 adverse, 1,800 favorable. You're swapping X and Y and you're bringing in more of Z into the mix. So keep those little rules of thumb in your cheat sheet when you're going towards the end. Standard contribution per unit, don't reinvent the wheel. We've this done already. We have it up here. That's why the examiner gives you these questions first. 155 for X, 90 for Y, 260 for Z. And then you just multiply across. 1,250 less units at 155, 550 less units at 90, and 1,800 units extra at 260. So in this case, this will be adverse, adverse, and favorable. Whatever they are in units, they will be in money. So the favorable is higher, so just net off the other two. 224,750 favorable. Sales mix. All right, so that's an important, and we just put up there 224,750 favorable. So what does that mean? It means you had a favorable change in your sales mix. So why is there a mix? Because you're not doing 50, 30, 20. You're selling a lot more of Z. If you actually calculate it out, 5,500 over 18,500, the proportion of Z you've sold in the total is actually, it's not 20%, it's actually 30%, 29.7. So that's why it's favorable. You're selling a lot more of Z, but you're selling a lot less of X and Y. The reason it's favorable then is because you're selling more of the most profitable product. So what you're doing is you're substituting out X and Y, which are the least profitable, and you're bringing in more of the most profitable into the sales mix. So that's why it's significantly positive. So we know then our sales mix is 224,750 favorable. We can actually back into our sales quantity must be 234,750 adverse. Now that is just that is just the plug figure. We can prove that as well. You're not asked for it, but you'll know the relationship. These two added together must come to the sales volume variance. So we know then if we have this one, we would work back to that one. And I'll show you that for completeness because you can be asked it in other questions. So we'll take our template again, the sales quantity variance. So we'll look here, sales quantity. The columns here now will be AQSM, SQSM, and the rest of them are the same. Difference, adverse, favorable, etc. down along. Don't reinvent the wheel. You have these done already. AQSM it's used in both. Just slot them back in. So you have that from the previous table. They will always be a universal one to both tables. And this is just the budget then. All right, what are your standards? Your standards were 10,000, 6,000, and 4,000. So whereas the two quantities were the same up here, because we're looking at two AQs, the quantities will not be the same down here, because you're looking at AQ to SQ. What is the same is the mix. We're holding constant the mix. So these two are both 50% of the totals. These two are both 30%. These two are both 20%. So you're holding constant the mix, but you're changing the total. So the difference here is 750, and that's adverse because lower is bad for sales. 450 adverse and 300 adverse. And what you will notice is the difference here should be the difference in the labeling of the variances. Your 1,500 lower units sold than expected, and you tot them up, that's 1,500 adverse. So you know you're on the right track when you're checking your labeling. Standard contribution per unit is the exact same as above, so don't reinvent the wheel. That's why I like this tabular format. And that will be 750 times 155, 450 times 90, and 300 times 260. So again, don't be afraid to pause it now. Just double check you're happy yourself. And if it's adverse in units, it'll also be adverse in money. And that means our sales quantity variance is 234,750 adverse. And we know that's correct based on our knowledge of how the advanced variances all link together. Now that's an important point. Make sure you're comfortable enough with that and have those cheat sheets ready going in. You know advanced variances comes up usually once a year. The only trick is it the summer or the autumn paper, or is it advanced cost variances or advanced sales variances? Right. Now there is a shorter method to do the sales quantity variance as well, and we'll show you. It's called the total method. Now, I wouldn't advise students to just rely on this totally, but some solutions you might only see this one, so you have to be able to make sense of it. Tabular one is the way to go the whole time because it overlaps. You have to do tabular for the sales mix. There's no other method. In the total method, you only look at the total. So you look at total actual sales and you look at total budget sales. The total actual sales were 18,500, which is coming from this figure here. The total budgeted sales were 20,000. So you're saying you're 1,500 adverse. You made overall the quantity was 1,500 less than expected. Now your trouble is, well, I need to put that in money terms. So what you have to get is the weighted average CPU. So instead of doing them individually, you take the weighted average, which will be made up of 155 for X times 50%, because that's the expected sales mix, plus 90 times 30%, plus 260 times 20%. So again, it's not as obvious where the figures are coming from. you're getting these three individually, and you're saying, well, each of those in the standard mix would be 50, 20, 50, 30, 20. So you're trying to simplify that table, which would be 155 times 0.5 plus 90 times 0.3 plus 260 times 0.2. So 157, and you multiply that by 1500, which gets you your 234,750 adverse. So either approach is fine, but sometimes this is not as obvious how you get it. So relying on this for the exam can be tricky and risky because there's not too much working marks available, because you either get it fully right or fully wrong. So what you're saying here is you've had a positive mix, you've sold a lot more of Z, but overall your quantity is down. You've sold 1,500 units less than expected, which is a drag on the quantity. So it essentially eliminates or cancels out any benefit you got from the sales mix because you're selling less quantity of units overall. So that's the first part, looking at sales price, sales volume, sales mix, and sales quantity. The last two then are the other two advanced cost variances, market size and market share. So if you take that sales volume variance again, and we bring it down here, we can actually split that into market size and market share. So you can split it another way to get different information. This looks at, did the overall market for each of them grow or decline in the period? And this, did your share of those grow or decline? So we'll focus on market size initially. And I look at three elements: element 1, element 2, and element 3. And this tries to give you an idea of how to calculate them, particularly when you're doing your cheat sheets out. So the market size here, you look at actual size versus budget size. So this will give you an answer: is the overall industry size bigger or less than expected? So that's going to be an answer in units. You then look at your budget market share of that size. So you're going to multiply it by 2. So you're going to multiply that, and then what you're going to multiply by is the standard CPU to monetize it. So step 1 gets the difference in the overall industry, the market size. You then multiply that by, well, what was your expected share of that overall industry? Because if the industry is up 10,000, you're not going to get the full 10,000. You're only going to get your share. And then once you have that, you get the number of units. Sorry, you get the value per unit using standard CPU. So I'd always put it in those three elements to explain along. So for X, let's have a look at it. X is the domestic market we know. So its industry, put there 11. Its industry here, actual is 80, budget is 100. So that's going to be 80,000 versus 100. So I'd put there, that's 20,000 adverse. So the overall industry for X is 20,000 lower. The budgeted market share here, this way you have to be careful. What was the budgeted market share for X? To get the budgeted market share, it's budget over budget. The budgeted sales for X were 10,000. The budgeted market size was 100. So that is 10%. So what that means is, if you translate across the 20,000 units that the industry is lower, if you lost your share of that, you would be 2,000 units worse off. And you're going to multiply that by the standard CPU for X, which is 155, which means 2,000 times 155 is 310,000 adverse. Just make sure you understand that logic. You get the overall industry decline, your expected share of that decline, and monetize it then based on standard CPU. So maybe pause it now and see, can you do Y and Z in a similar format and interpret what it means. So Y, same logic. Industry expected size was 40, it actually only was 35. So that means you are 5,000 units worse off. The budgeted share of the commercial market, which is product Y, budgeted sales of 6, budgeted units over all of the industry of 40. So 6 divided by 40, I'm just looking at percentages, is 15%. So 15% of that share would have got you 5,000 times 0.15. You'll be 750 units worse off. So if you took your share of that decline, we don't look at actual market share here. That's for a separate variance. So we're holding constant, just looking at the budget share. And each unit there is a contribution of 90. So because of the industry decline, you're worse off by 750 units, and each lost unit loses you contribution of 90. So that is 67,500 adverse. It's a declining industry. And the last one then, Z, similar. So see how structured we make it. You put each of the points, you make it very clear where the things are coming from. Right, that's to show the examiner you understand exactly what it's about, and this is what the cheat sheets are there to help you, and you'll annotate your cheat sheet with useful tips the more questions you go through. So the last one then, the industrial is actually 10,000 bigger than expected, 50,000 versus 40,000, which is 10,000 favorable. Your expected share of that market was 4,000 units over 40,000. Remember, budget sales of yours over budget industry size. Never mix them up. That is 10%. So that will be 1,000 units favorable. And that is the contribution per unit there, 260. So because the overall industry was bigger than expected, you're going to get an extra expected share of 1,000 units, and each extra unit is worth 260 to you. So that's 260,000 favorable. So when you're doing your market size, you do them individually and you tot them up. So here it's 310 plus 3675 minus net off the smaller one, which gets you 117,500 adverse. And that is your market size. So overall, the company is losing sales or losing profits because the market is declining for X and Y. Slightly been compensated for Z, but not enough. So 117,500 adverse, and I'll put that there. So that means we know the market share variance should be 127,500 favorable. Sorry, 107,500 favorable. Right? Because if it's not, you're not going to get back to 10,000 adverse. So you can kind of back into what it should be before you go down. So that's a useful sense check. If you know the relationships, which you should have on a visual chart in your cheat sheets, it can help you along the way the examiner lays it out. So if we come down then and look at the last one, the market share. The market share here, again, it's 3 elements. So I'll copy down the 3 just to show you that they slightly change. In this case, we're now looking at what is our share of the market. Did it increase or decrease? So you look at actual share versus budget share. And that answer will be in percentage form. What was the actual market share versus the budget? You multiply it by the actual market size. What was the actual size of the industry? And the last one then is contribution per unit. So you kind of do it in reverse. Number 1 now will be percentage. Number 2 will be units. So for X here, what was your actual market share? Now to get your actual market share, it's actual over actual. What we mean by that is the actual sales for X were 8,000, the actual units for the domestic market were 80. So that's 8 over 80, 10%. 10% versus the budget share you've done already up here, 10%. So that means there's a nil difference. The actual market size, not that it makes much difference here, 80, and the contribution per unit, 155. But that is a nil variance. You actually held your market share for X. So even though it was declining market and you're losing because of that, you're still holding on to your 10%. And that's probably the variance that's more relevant for managers' performance. They may not have an impact or an influence on the overall industry, because that's to do with the economic environment, government policy, etc. But they should be able to keep their market share vis-a-vis their competitors. All right. For product Y, the actual market share, remember go back, it's actual over actual, 5,000 sales over 35. So 5 over 35, just be careful there. If you do equals 5 over 35. That is actually going to be obviously 1/7, which in percentage is 14.286%. What you're trying to do here, just to illustrate, is 14.28%. Try not round. Trying to go to 3 or 4 decimal places, because if you round, the totting at the end won't work. And we'll see in the suggested solution that the CAI put out, they've rounded and it doesn't make sense because there's obviously going to be a rounding difference. Compare that to the 15%. You're going to have an adverse variance. So 15 minus 14.28, which is 0.72%. Here, point adverse. You're going to have an actual market size, which was 35, and the standard contribution per unit here was 90. So essentially what you're saying here is, because your market share is lower than expected, you're going to lose out. Now, the difference here, and I'm not going to round, I'm going to say it's 14.2857 compared to 15, and you multiply that by 35, that gets you an even 250 units adverse. Now, if you round, you're not going to get that exactly, but the reason I want to do that is it makes everything neatly fit together at the end. So because you lose market share, you're losing a small bit of the units compared to the budget, and each unit is losing 90 on contribution. So 250 times 90 is adverse 22.5. And then Z is the same. Z's actual market share is 5,500 over 50,000. That is 11%, 55, compared to expected 10%, which is 1% favorable. So you have a 1% bigger market share than expected. That 11% is 5.5 actual sales over 50 of the actual industry. The actual market size was 50. A 1% gain means you have an extra 500 units because you grew your market share, and each of those is worth 260. 260 times 500 is 130 favorable. And when you tot them up, you get a market share variance. Now, of course, I should be taking that away because it's adverse, of 107,500 favorable. And that is exactly what we said we should expect. The 107,500, which is this up here. Right, that's important. Just to flag it to you, when you look at the suggested solution, they will have 107,950 because they have rounded to 14.3%, which means this is slightly off. And if you're trying to sense check those two back then to the 10,000 above, it won't balance. And you might think you're wrong. So just be careful with your rounding if you're trying to link everything together. Right, don't be put off there. The technical answer there is 22.5. So what does that mean then if we had to interpret it? Well, it means the industries of X and Y are declining. So the overall industries are declining significantly in the terms of X. X is holding its market share, so it's still holding 10%. Y is slightly losing its market share. So in terms of how X and Y are competing vis-a-vis their competitors, they're not too bad because they're maintaining roughly their market share. The big concern is, though, the long-term sustainability of those two heating systems, because the industries are obviously declining significantly. They're the types of comments we're looking for that you can interpret what these mean. For Z, on the other hand, this is a growing industry because it's growing by 10,000 units, and we're growing our market share. So that's really the big stellar performer in this portfolio, is the industrial heating systems. And that's the ones you want to focus in on when you're making your comments. For example, when they come and they ask for part F, G and H about financial measures, about performance measurement and the strategy, you're linking in the information you have in the variances. And that's usually where students let themselves down, is they can do the calculations because they have the open book in front of them, but they can't interpret. So focus on interpretation, and hopefully these videos can help you in that regard. So that was advanced sales variances, also looking at Cap 1 sales variances, Summer 18, question 1.